All right, so we're going to look at the S&P 500 and the VIX on the short term. Stock market moving up to an all-time high right now. As we record this now with a few hours left to go in the market on Thursday, the last day of the week. And happy Easter and happy Passover to everybody who celebrates out there. And this information I think you're going to find really interesting, because the value of using the stock market index and implied volatility will be seen here pretty clearly, because the correlations are important, especially when you look at cycle analysis. So I think you're going to find this quite interesting. I'm going to go to a daily chart of the S&P 500. There's that IFRA, and if you're just watching this clip now for the first time on YouTube, it's important to go watch this analysis on IFRA, which I did earlier in the show. So we're going to go to SPX, and we're going to look at the cyclical patterns that we see right in here. So these are complex cyclical structures that we're looking at. On the bottom, the cycle brackets, and the actual cycle lows show up on those dotted blue lines. We've had an average of about 30 days, now tightening up to about 28 days on these cycles. And we have a mid-cycle lows that have been showing up right around the 13 to 16 day area, as you can see right there. This one was 14 days off of this low right there. That's the minor lows here and here and here. And you can see one right over here also. So now we're in this second minor rally right over here, and we've moved up through what were our projections there based on the level of the fib extension there right over there. It kind of got through it here and then rejected here late on Wednesday, and then Thursday now it's moving up through it. Now our target right over here was about 3081, 3082, something like that, and now it's moved up through that, and the high was around 4012 today. For those of you that have seen our weekly SPY analysis, we were looking for about 410 to 415, and then the next level was about 485 to way up over here. So this right over there is about 485 in the SPY, 408 on the SPY, to this level up here about 411 on the SPY, and this is 4085 to about 41 over 4100 here, 4140. Right at that level. It could make it up there, but we're getting into a period right over here where there's a likely pullback. And why do I say that? Well, the period of risk is when the minor cycle and the dominant cycle come down together. You can see that right in here, and right in here, and right in here, and then likely showing up right in here. So this, as it moves further away from the slim ribbon right in here, it starts to put the distance on, which then calls for kind of a mean reversion, and you start to get a pullback into this corrective period. You can see in here the slim ribbon, how this bullish signal came right in here on that arrow. It turns the slim ribbon PO positive, and all of these bullish signals that we see in here turns neutral on these corrections, and it's probably going to turn neutral again. So what we're looking at now is for this corrective period to come into play, and then moving up again. It's just modest. We'd say 2.5 to 3.5% pullback in here that probably gets you down somewhere in here to about, we'll call it 38.95 down to about 38.60. So that would be approximately 120 to 150 points in the S&P 500 over the next week and a half, and then moving up again. So this is a short-term view. We're looking at about the next two, three weeks as we look at this, and the likelihood that this will not extend up into that higher projection there, but the potential for that to happen out over here. Remember, we're looking for higher prices out into spring, so that would not surprise us. So this is a bullish configuration as we look at it. It would take a move down below this area of 37.23 in order to get negative. And there's not much of a likelihood of that unless we get into some very, very strange panic. So while you see that these cycle structures continue to be positive, projecting to higher highs, the next one over here is likely to do the same thing. When I put up the VIX, now you would expect that the VIX would be giving signals of something that's negative. So here are the daily patterns on the VIX. Now there's something important I want to show you looking back a little bit further. And that is when you look at this huge advance in the VIX, and then that happened a year ago, March, in the panic when COVID hit. Then you had that next VIX cycle right in here where it rallied up a little bit and then took out that low. That projected to the VIX declining all the way through this period right over here. And you could see it exactly did that. Here you had the same type of a pattern, but more sideways, and this more sideways also. And what you see going on right over here is really important to note, and that is similar to what we saw a year ago. You had this big upward spike in implied volatility, and now this cycle turning negative. That projects to lower implied volatilities, or a choppy trend in implied volatilities that takes you out where? Out to this period right over here, and I'm going to highlight the dates, May 16th, May 16th, May 16th. So like we said, we expected the stock market to rally out into sometime late April through early June. This points to May 16th as the end of the downward trend in implied volatilities. So while I'm thinking that the stock market has a pullback coming in the next couple weeks, maybe you get implied volatility popping up in here. Now we've downgraded this based on cycle shapes. I want you to see that. On 331 we downgraded it, and we're looking, instead of what we were looking for, to a pop into the mid-20s or high 20s, now you see this declining wedge that's built in here, and more of a likelihood that it can't get really much over the 20 to 22 area before it then moves down again. So maybe you get a brief uptick here in implied volatilities over these next couple weeks, then it begins to come down again. You can see the wedge, you could see the negative conditions here in implied volatilities, and that matches up very well with what we're talking about in the S&P 500, which we expect these upward conditions to remain in place. So again, what we're looking for in the next 1 to 3 weeks is a topping in here, a pullback of some 120 to 150 points in the S&P 500. We'll just call it a 2.5 to 3.5% dip, not much, and then another positive structure following after that.